So the next section, we're going to talk about another new method to evaluate a single project. It's called the future worth method. Okay, so just recall that the present worth method is going to convert all the cash flows back to the present time and compare that with 0. And so the same logic, the future worth method is to convert all the cash flows to the future time, okay, to the end of the timeline, and then compare that with the 0 as well. That's very easy to understand, okay? And of course, the interest rate you're using to convert the cash flow to the future time is also the MARR. Okay, so also you have different scenarios to convert. You can have single cash flow at the beginning. Okay, so you have single amount investment at the beginning, and after many years, you're gonna have some receiving out of that investment. And what is that feature worth? You just wanna convert that to the future time, okay? And also, if you have multiple transactions or multiple cash flows, you're gonna have multiple parts of the FW, FW1, FW2, FW3, ... So you want to convert multiple times using the factor method we have learned in chapter 4, and then you sum them different parts up at the end, and then you have the total FW and compare that with 0. Okay. Also, you may have annuities going on. Okay. So annuities going on, and the thing is, you want to convert the annuities to the end of the timeline and have a FW. And once you have the FW, including all of the cash flows, you're gonna compare that with 0 to see if it's bigger or equal to 0. If yes, then that project is acceptable. If no, you're gonna reject it. Easy to understand. So this example is exactly the same as the one we used for the present worth method, but I just want to give you a comparison. Like if you use present worth method and if you use future worth method, are you going to have the same conclusion? Okay, so that's very interesting to see. So okay, let's just use this. Okay. And the first thing, okay, so just to remind you what this problem is. So a piece of new equipment has been proposed by engineers to increase the productivity of a certain manual welding operation. So we're going to decide if we want to buy this new equipment or not, okay? And we know that the investment cost, so at present, you need to pay $25,000 to buy this equipment, okay? And then after 5 years, you're going to sell it to the market, and you can get $5,000 from that salvage. Okay, so somebody will buy this equipment as a second-hand equipment, and they will pay you $5,000. That's it. So that's one receiving you can get at the end of the 5 year. And also, at the end of every year, this new equipment is going to save you some money. Okay, they're going to lower your cost and increase your productivity. Anyway, so the net profit for your company is going to be $8,000 every year. Okay, and it is also given that the MARR for the company is 20%. So now you want to use the FW method to decide if this is a good project to accept or not. Okay, so now let's just draw this diagram. Actually, it's gonna be exactly the same as the one we drew for the present worth method. So timeline 0, 1, 2, 3, 4, 5. Okay. At the beginning, you're gonna invest 25,000, so it's outgoing and it's long. The arrow is going downward. And every year you're going to receive, okay, so at the end of the 5th year, you're going to sell it at 5,000, so that's one of your income at the end. So it's 5,000, a shorter arrow going up. And then every year you're gonna have net profit 8,000. So you're gonna have some annuities going on this timeline. Okay, so at the end of the 5th year, that's additional 8,000, and the A is 8,000, and your I% is gonna be your MARR, which is 20%. Okay, that's the diagram. And now let's look at the problem. It asks you to use the FW method, future worth method. So you're gonna convert everything back to convert everything toward the future. Okay, so the question is, what is the future worth? And actually, the future worth is you convert everything to the end of the 5th year. Okay, you can write it as F5. That's exactly what you want. Okay, so what is that? First, we need to determine how many parts of that future value has. Okay, so we have this 25,000 initial investment at the present time. Okay, so we have FW part 1, which is from the 25,000, and it is the present value, okay? And we want to convert that to the future value. And the second part is the 8,000 annuity. So you have FW part 2, which is from the annuity equals to 8,000, and it is annuity, and we want to convert that to a future value. Third part is from the 5,000, okay, the resale price, and it is a future value. So actually don't have to do any calculation. That already happened at the end. Okay, so now you can go ahead and calculate each one of them. So FW1 is to find the F given P, right? So the equation is gonna be P times F slash P MARR N. And P here is 25,000. Be careful because this is expenditure, so you're gonna have a minus symbol in front of it. The minus or the negative sign only tells you it's outgoing cash flow, it's expenditure. Okay, it's not some value lower than 0. So negative 25,000 times a factor F slash P 20%, N is 5. So it's negative 25,000. you need to find out the factor in the table of I equals to 20. So it's to find the future given present, it's this column, and the number of n is 5, so this is your factor. $2.4883. The final result of this part is negative 62207.5. Then continue with FW2. FW2 is to convert annuity to a future value. So the equation is A times find F given A, MARR, number of n. Okay, A in this case is 8,000, and because this is a receiving, so it's a positive symbol. Okay, so positive 8,000 times the factor is F/A for 20% for 5 years. So it is positive 8,000. We gotta find this factor. It's F/A, so it's this column. And n is 5, so this is your factor. 7.4416. So the final result of this part is 59532.8. The third part is already occurred at the end of the 5th year, so you don't have to convert anything. So it is positive 5,000. Okay, now you need to sum the 3 parts up to know what is the total FW. So negative 62207.5 plus 59532.8 plus 5,000. The final answer is $2,325.3. And this one, if you compare that with 0, it is bigger than 0. So we say we want to accept the proposal.